So yes, as was mentioned, I have the great pleasure of leading operations at the Bold New Normal and putting all of this together and really supporting the great work that TLQ, as I call her, the Lucy Quist, is doing both home and abroad. It's such an honor to serve this mission and work so closely with you. And I really want to continue the conversation we've been having. So it's interesting, we said let's have a conversation with builders. And of course, what's the thing that comes up? Money, right? And in my country, they always say something. Who are the Nigerians in the room? They always say, "Owo ni." They say, "Owo ni, owo ni," which basically means money is the main thing. Like, after all is said and done, money is it. So we need to have the money conversation. And so I'm going to be hosting a panel today called Both Sides of the Table, Building and Backing Africa's Next Enterprises. So this is the time to think about all your money questions. And then, when I think about the room, I would say that we have the builders in the room and then probably have the bridgers in the room, right? So who are the people who are looking to do something on the continent? Let me know, show of hands. You want to get your hands dirty, you want to go home. Go home? Come see, come ça? You want to go home. And then who are the bridgers who are like, you know what, I'm going to send my money home. I'll send my money on an errand. I can live here, things work here, right? I'll send my money home. So we're going to have that conversation to suit both sides of that room, right? So the builders who are thinking, look, I want to do something, but the vision and the ideas that I have are so large, and I don't know that I have the capital to do this. How do we even start to engage? First, operationally, starting to get our businesses off the ground or ideas off the ground, and then starting to engage larger levels of capital. The second group of people are those who are the bridgers. How do you start to think about investing? How do you find good opportunities to do that? So that's really what this conversation is going to be about. And joining me are two amazing builders and bridgers who are really going to have this conversation. So first up is Ayim. And I used to call him Ayim for a long time. This is Nigerian in me, but I figured out that it's not Ayim, right? It's Ayim. And so, let me look for your... All right, so Andy is... Ayim MBE, let's put some respect on it, is one of the... Can we get a hand clap for that? I mean, look. He's an MBE, right? He is one of the most influential voices in British and African angel investing, born to Ghanaian parents and raised in Tottenham, North London. Andy built his career across Ernst & Young, Silicon Valley, and Backstage Capital before founding the angel investing school, which then became Ayim Limited, Ayim Limited, the platform that has trained over 1,000 new angel investors and has democratized access to early stage investing for communities historically locked out of the room. His alumni include a group of Black Googlers who went on to collectively deploy more than $20 million. Awarded an MBE for services to entrepreneurship, Andy brings the retail investor lens to the Bold New Normal UK 2026 and is really going to be answering this question with a characteristic candor. So thank you and help me welcome him to the stage. Let's give him some beats, baby. Hey.
If it wasn't you that's on my side.
None of my speakers dance today. We set up some nice tunes and no one really gave. We might do a dance and Andy, right? We might do a little jiggle for them. And second, but definitely no less important, and I don't see her in the room. Oh, there you are. Hi, Fope. Hello. Fope Adelowo is a principal at Helios Investment Partners, one of the largest Africa-focused private equity firms on the planet. Those are big accolades. And she's managing over $3 billion in funds. As co-lead of the firm's Digital Ventures Fund, she leads investments in African technology and fintech with a portfolio that includes PayMob, Tunes, TPay, Mobile, and Seamless HR. Fope holds a first-class MEng from Imperial College, London, Clarkett, and an MBA from Harvard Business School. Her career has spanned Goldman Sachs, Clarkett, Boston Consulting Group, and Jumia, and she brings to the Bold New Normal UK 2026 the institutional investor lens, really asking the question or answering the question, what serious African enterprises actually need to look and attract the type of capital that they're going to use to scale. Please help me welcome Fope to the stage. I mean, look at those pants, baby. She's working it. I love it. I love it, I love it, I love it. This is such a brilliant conversation. I spent almost 20 years in banking myself on the investing side, lending to technology, media, telecoms companies, and it was a season of my life where I was leading sort of our sub-Saharan Africa investing. So I know just how easy my life was when I was doing work on the European continent. And when I decided to take the job in sub-Saharan Africa, and I literally deployed zero capital in like 2 years. No money left, because every time I would go to the committee, nothing would get approved because of all the things that were talked about. You know, Africa's viewed as risky. You know, people are thinking they'll go in, but they're not going to come out. There's a whole host of things. So I'm really excited to have this conversation. I hope you guys are too. Okay. Before we kick off, I want to just share some stats that I looked up. I thought it was really cool, because we've been having the conversation about money going into the country, but what is money going in for? So some statistics actually say like African diaspora send home roughly about $100 billion every year home. And that is double what Africa actually receives from any kind of overseas development aid. The second stat I want to share with you is that in 2025, African startups raised $3.9 billion across 506 deals. And to put this in context, Africa was the only global region where venture capital activity didn't decline in the last year, which is pretty cool. And the third stat I want to share is that African investors actually accounted for 45% of venture fund commitments in 2025, and this is an increase of 23% on the prior year. And in most of this was actually coming from the diaspora itself. So these are brilliant numbers. We should celebrate that, yes? I do call and response around here. I like to know that you guys are in the room. But you know, those are decent numbers. You know, they maybe on the surface they maybe shatter some myths that we think about. You know, money is moving. Somebody say money is moving. Money is moving. Whether you like it or not, whether your own money is part of the money is moving, right? But let me also balance this, right? Before we celebrate those headline numbers, let's look at the structure beneath, right? So most of all that money raised, the $3.9 billion that I mentioned, barely any was in any serious series rounds, right? Like B or C. They were all more mom and pop, angel, like much smaller investing. So it's worth kind of noting that scale of investing is much smaller than we think. The $100 billion that we're celebrating, almost none of it went to enterprise. It mostly went to bills, hospital, feeding, black tax, all the like, right? Not a single amount went to enterprise. And of the founders who do build, raise, and grow, the exit is quite narrow. And I'm sure I can talk about that a lot, right? There's money going in, but it's so hard to come out. And I know as investors, one of the things that, as investors and also as builders, one of the things that people will be talking about is, when will I get my money back? I'm not gonna go in if I don't know how I'm gonna get my money back, right? And so that's the landscape which I want to have this conversation, with that balance in mind. Like money is moving, but money is moving to what and in what way? So I'm going to start with the questions here. So probably to both of you, actually laying the foundation, how would you think about your role, both whether retail or institutional, in the Africa enterprise ecosystem?
Who started this?
Andy, let's go.
Okay, I was going to say ladies first, no problem. So I'll just share a little bit of context, because I think context is always important to really understand the background of where someone's kind of vantage point lands. So in 2022, I trained the top 100 black executives at Google on angel investing and helped them form this angel group that was mentioned earlier. And they deployed about $20 million in 5 years, and now they've launched a venture fund for $70 million. The reason I share that context is because when we look at Africa and Ghana even specifically, we're at a different stage of the cycle in maturity when it comes to venture capital and early stage funding, and we have to accept that for what it is. So it's not helpful actually when we compare it internationally. And what I mean by that is when I was on the ground, I lived in South Africa for 1.5 years, Ghana, I've gone back and forth over the years. The background and the context of where wealth and business is created is actually a lot in like infrastructure, agriculture, commodities. So we have to understand that for them actually it's quite foreign to think about taking risk and investing in early stage technology companies. So the Angel Investing School exists to bridge that gap by building trusted relationships with these type of individuals and communities and educating them and handholding them along the journey before making their first investments. And that just takes time, and we have to accept that for what it is. The reason that it's important is because when we think of value capture across Africa, right now so many of the diaspora and African founders are starting Delaware companies in the US. And the reason that they're doing that is because by incorporating there, their IP is protected, they get into these accelerators that needed to incorporate in the US, like Y Combinator that was mentioned earlier, and also they're trying to tap into that talent that's abroad. The reason that this should create a concern for Africa is because as governments, they're not capturing the value, they're not capturing the tax dollars. So as these companies like Flutterwave and Payson and Instant all exit from Africa, actually all the value capture is happening internationally. And if they go and list on a public market, like the NASDAQ or even the FTSE in the UK, again, we lose out on all of that value capture. So it's going to get to a point where governments are going to actually start realizing that we are incentivized to incentivize early stage investment in our countries in order to capture the value here. I'm not going to go, I think we'll talk more a little bit later, but I just want to set that as context before we get into this discussion today.
Yeah. Yeah. No, I think that's a brilliant point. So, I mean, we come at it from institutional capital. And I'll give two angles. So one is, as a fund and as a platform, we actually see ourselves as a bridge between global capital to investments on the continent. So actually, a lot of our investors are institutional, US investors, sovereign wealth funds from Africa, not from Africa, actually. Less than 2% of our funding comes from African investors. So that's the second angle that I'll come to. But most of the money we invest is from US pension funds, UK pension funds, DFIs, etc. And I think to Andy's point, that pool of capital is important because, as I think Ife and Yao said earlier, a lot of the capital they got was from diaspora initially because there's an understanding of risk in a very different way to local investors. I think obviously historically local investors have made money from real estate, trading, etc. That's the thing that they get. So I do see, the role that global capital has to bridge the initial gap. But that has to change, to your point. So the other side to that is one of the ways that changes, I do think is also seeing the cycle happen. Mm-hmm. So people invest, they make money, they exit. And actually, I would say in 2020, between 21, I can't remember the year post-COVID. Every time I think of COVID years, I'm like, what year was that? Between 21 to 23, we saw the biggest sort of interest from local investors and VCs, even pension funds, who, for local pension funds, if you come to them with anything, they're like, what's the dividend yield? You're like, it's a growth company. There's no cash. There's nothing to pay dividends on. But even pension funds were interested because what had happened, Paystack had gotten an exit, Flutterwave raised a big round. So they were starting to see, okay, there's proof of concept in this. And I think that's what global capital does, and it's still important. Now, the only thing with global capital is, to your point, when there is any big macro issue in the market, global capital is the first to get out. That's number one. Number two is, you're restricted to some extent to the understanding that global capital has as to what makes a good investment in Africa. So what might seem great in Silicon Valley is very different to what makes a good business in Africa. Like an agency network, for example, where you go to a corner store to give them money and buy airtime. Like a global investor can never understand that, but it works, and you need that. That's infrastructure for banking. So I think there's that comes with some restriction, which is why we need local capital. And I think for us, this is the second angle. Actually, one of the things we're doing now is spending time with local pension funds to say, okay, how can we design a product for you so that you can get exposure to these alternative assets in a way that you can understand it and make sense. But yeah.
Can I just riff off that quickly as well? From a talent perspective, in that same time period from 21 to 23 with Flutterwave, Paystack, there's two things that happen that are really important. The first is that with those exits, those entrepreneurs then invest back into the ecosystem. Flutterwave founder, he's always investing back into the ecosystem. Same thing that happened back in the day in San Francisco, the entrepreneurs that exited, Mark and Greece and A16Z. The second thing that's happened that's really important is talent is getting nurtured and developed. So those talent that were early employees are now more wealthy. They can go and start businesses themselves. They can go and invest and mentor and educate other people starting businesses. And the third thing that happened is international tech companies went remote first because of COVID. So now Uber is hiring people in Nigeria and in Ghana and Airbnb, and therefore there's upskilling the nation again. So all of this is actually developing the talent that we're talking about to become future founders, but it takes time. And the same way Africa's perceived now, just remember when I was a child, they were talking about China in that way. But China's government has made different choices to say, I'm not interested in Facebook or Google, we're going to build our own. And that's the difference in how they took control of their narrative. If we did the same in Africa, we'd have a lot more control right now in creating wealth and technology as well.
And I'll just make one last point. I'll actually even go as far as to say that from an investor perspective, global investors, what I found when speaking with them is, to some extent, yes, Africa is the thing that gives them a reason to say no, but all they care about is returns. They couldn't care, like if you showed up and said, look, this business is going to deliver you 10x in 5 years, and I've proven it because I did it the last 5 years, I bet you they will invest. They don't care if that is in Africa or not. So to your point, it's now we have that ecosystem of founders, the institutional knowledge, people developing really interesting ideas, and I think actually we will, get there where we have those proof points.
Brilliant, brilliant. I want to pick up on a couple of things that both of you said. So as you're talking, what is going on in my mind is that then the equation is broken then in some ways. Because you have, as you said, African builders who need to build for an Africa that they understand. But these same African builders are chasing capital from investors who don't understand the market and who are also valuing but these founders are also valuing their businesses based on metrics and KPIs that are not actually supposed to be theirs. So when I think about that circularity, it just feels like we're just all going around in a loop. And potentially why the results we're seeing in terms of ability to raise funding, ability to really be attractive. So as you're thinking about some of the businesses that, businesses or even, smaller, startup founders, maybe scale-up founders that you are dealing with, how should they really be thinking about, one, building for the markets that they're in, and then secondly, approaching valuation and capital raise in a way that is more aligned with what they're building?
I think the first thing would be helpful if I just define that an angel investor is different to an institutional investor, okay? An institutional investor has a financial institution, a company, and they've raised money from other financial institutions like pension funds, endowment funds, other fund of funds. So they've got a duty to return those funds to those investors, okay? Some of them don't raise fund 2 and 3 because they don't succeed with that duty. An angel investor such as myself, I can do what I want with my money. I can go casino, I can put it in your business. It's my choice. But the difference in that incentive structure is really important because what it means is that I'm actually investing what I can afford to lose. So my motivation is different. So I invest, I write it off, and I roll my sleeves up and I go to work as an extension of the team. That's what they call smart money as an individual. And I know that my capital isn't a differentiator. That's not why you pick me. It's because I can add value in your knowledge gaps that I'm aware of, or I can make what I call transformative introductions. There's founders that I've never invested in, I've made transformative introductions. I introduced Lucy to a fund. I've introduced people to Google and to Microsoft. That 250k contracts is more than I could invest in them, but it also means they get to keep equity and guard more ownership in their business. So what you look for when you're speaking to an angel or to an institutional, you have to actually step in their shoes and understand their perspective first, to then tailor your story to then appeal to that person in the right way. And I think it's really important for founders in the room to understand who they're talking to and then how do you tailor your story. So if I was talking to someone with an agriculture background, family-owned businesses, many generations, I would stroke that ego and I'll enter that relationship from that vantage point, right? You saw the founder of the ID company earlier, right? Like, you've heard so much context there that you know numerous points to now connect with him, to nurture a relationship. And guess what happens when someone likes you? They're more willing to invest in you, right? So, and that's what we're getting wrong. We're leaving it too late. We're at the point of transaction, we build relationship. No. That's not the way to do it. We have to build relationship long before we transact. It becomes a lot easier.
Yeah.
It's a beautiful tip, yeah. I mean, and I see this even in employment, right? You want a job, but it's only when you want a job you send a LinkedIn message. So it's almost a mindset that, you know, we don't wait to the point that you need something and there's desperation before you then start to, you know, build the foundations that are going to help you be successful.
Yeah, no, it's an excellent point. I mean, one of the things I always say is, and I say it's in the context of fundraising, whether as a fund or a founder, is always be closing. Which is like, fine, you've raised your Series A round, but still, like, you're going to have to raise Series B. So always be closing. Every conversation you have, be meeting investors all through the way. I think the way you describe the kind of what drives investors and why they're making investments is so critical to how founders should be thinking about when to approach an investor and which type of investor to approach. So obviously you have the full gamut from seed to private equity. A seed investor, like you said, you can afford to lose your money. You're looking for 100x. By the time you get to private equity, you're like, okay, you know what, just give me a 2 or 3x return, you know? And that means that the sort of scale of the business looks different, the kind of risk that someone is willing to take. Look, if you're a seed investor, you're investing maybe on a paper idea, you don't know the idea, so the risk you're taking there is massive. By the time you start to get to your Series B, Series C investors, you need to have something. There needs to be a product, there needs to be some revenues, there needs to be, some of that risk needs to be out of the equation for that sort of later investor to make that investment. So I think that there still tends to be this misalignment from a valuation perspective. And it's unfortunate because, again, you know, early VC, I would say outside of seed in Africa was driven by global investors. And the metrics were fully Silicon Valley metrics. I think Cecil was actually saying it that, yeah, you know, they expect you to grow 1 million customers in 18 months. Like, where are you going to find those customers? Where? You know, so I think, I do feel like people are coming around to understanding that sort of, okay, you can't be expecting 15 times revenue when you haven't sort of scaled the business, and really being comfortable with because actually what used to happen was, you know, we African investors, because my fund focus on Africa, we're mostly Africans, we were like the black sheep for founders, because we, you know, a US investor will be telling you, I'll give you 15 times revenue. We will come and say, maybe 5 times revenue, you know? And we're the black sheep. But I think there's a coming to Jesus moment between both sides that say, like, okay, look, what we're building here, you know, the scale that you're expecting, the speed you're expecting is very different to Silicon Valley and what should earn a 15 times revenue. Number 2, the market has just changed, actually. I think your stats said that more of the investors in the last year were actually diasporas or Africans. So actually the way we think about risk and et cetera is different. And then I think ultimately, the other thing I say is, you know, where misalignment also comes is what type of business are you building? Some businesses maybe shouldn't be funded by VC investors, right? And that's when you start to have, I always say, like, look, if you give me a sardine tin and I open it, I expect to see sardine, not tilapia or tuna inside it. That's what it should be. Yeah. And so also knowing that, okay, if you're building a more granular, you know, asset-heavy business, that's very different to a tech-light, high-growth, we're growing 100% year-on-year business. And the type of investors you want to approach might be different. So if you're tech, you know, you're asset-light, tech-forward, high growth, go to a VC investor. If you're building something more granular in the agri space, in the manufacturing space, you may need to be speaking to some family offices that have actually done that and built that before, some strategics. So you're just thinking through those different elements.
And earlier, I think Her Excellency touched on something called, I think it was called Remit to Invest. You know, in the UK, we've got these tax incentive schemes introduced by the government called EIS and SEIS. Put simply, what it means is that if I invest, let's say £10,000, I can get 5,000 back claimed through income tax. These incentives incentivize early stage investment.
If you're a high rate taxpayer, that is.
Yeah, you're more likely to be if you're investing into early stage startups. But we need the equivalent across Africa, actually.
Yeah.
We need to incentivize the behavior and reward it with things like tax so that people are more and more engaged and interested in doing that type of activity. And for all of the founders in the room who are like, oh, how do I build relationships to invest? If you start connecting with someone, you tell them, oh, do you mind if I just add you to my investor update email? You haven't even got that yet. But it's basically a newsletter that you'll send every 2 or 3 months to give them an update on this was the key things that happen on the product, key hires, key developments, and here's my ask. And what you're actually creating over time is a narrative and a story to create FOMO. And that investor feels that they're missing out because you're sharing more and more traction over time. And I can't tell you how many people have raised investment that way 4 months later when the investor realizes actually there's something going on here. So to learn the art of developing relationships and nurturing relationships through things like that, that's the smart way to start building relationships over time.
Brilliant. That was a nice 101 on different types of investing and different types of investment markets. A word always comes to mind. My Gen Z siblings always say, you know, delulu, right? And I really want to get to what has probably been in your maybe investment committees or conversations you've had. That's one of the more delulu founder stories where you're like, you want what? How much money for that? You know, maybe the multiples, the valuation, the ask. Because I've definitely met a lot of founders in my journey and in my investing seat where I've actually just thought, you have nothing to prove that valuation. Literally, this is vibes and inshallah at this point. Like, you know, there's no nothing. So, and really people just trying to raise rather than grow. You know, so there's almost a bit of fantasizing somewhat around raising, and we see the headlines, right? Like there are more headlines around X person raised 10 million, 20 million, as opposed to X person generated this amount of revenue, right? Like we're so good at raising capital now, so distracted at raising capital that we're not actually focusing on building a business that is so valuable that people want to spend their money. So I do want to have that conversation because I can imagine there are people in the room who are thinking maybe the only way that they get ahead with their vision is that they need to raise. And it's like, no, perhaps maybe you need to build.
I mean, I'm just going to say, I remember seeing on Twitter the other day where someone said, you know, I just saw this founder saying on Twitter that now it's time to build. They're like, what have you been doing since? You've been in this business for 5 years. You're like, now it's time to build. And like, to your point, a lot of people are just like out there raising and raising. We've had some really interesting IC conversations. I remember once someone came and I liked the business. I took it to IC. I knew I wasn't going to get to the valuation. But obviously the question came up as what was their expectation? And I had to say, and everyone fell off their chairs. And I had to be like, calm down. Like, that's all we're going to give. But you know, when I asked the founder why, it was like, well, that guy there raised at that valuation. And it was actually an interesting one because, you know, there was a bit of it seemed like it was a gender thing, which it wasn't. It was just like the businesses were very different, serving different markets, and we just had to have that, you know, very realistic conversation. I think, you know, for us, when we think about, okay, what are you building? When should you be going for that sort of big valuation? When does it make sense? You need to have a product, like you said. Like, you just need to be like focusing on, okay, what do I need over the next, 12 months? What do I need over the next 24 months? And can I raise just what I need for that rather than going for the big round? The other thing is like, you know, people get distracted about the valuation numbers. All these valuations are very structured. Like, you know, someone may say they raised 10 million. Actually, 5 million of that is in kind. It's not actually cash that they raise. I think to Cecil's point, you know, you could be raising like Amazon gift vouchers or whatever, so it's easy to get distracted with the numbers, the valuations, but that's not really where people are raising from, because investors know how to structure the hell out of these things, and when you take all of that away, actually they're raising at a 50% discount to actually the number that they put out there. So I think it's just important, like, have a product, come out, have a conversation at various stages. There's no need to raise all the money at one go. And figure out, okay, what are the key milestones that I need to get to, that I need to raise for, and then I can come back to market to do that. And I think those are conversations that obviously investors are willing to have.
Well, one of the things that I look for in founders is an ownership mindset. And for me, if you truly value the future of what you're building, you wouldn't want to give away too much equity. In fact, you want to keep as much as possible.
Yeah.
If possible, you wouldn't want to give away any equity, because you believe in the future value of what you're building. If you're giving it away too cheaply and easy at the beginning, it tells me that you don't even back yourself, so why should I back you? So it's really important for founders to really understand what it means to have ownership in their business and what that means. I work with a lot of micro private equity folks who do something called entrepreneurship through acquisition. They actually acquire businesses from family-owned businesses with no succession plan, and they carry on those businesses. Like, there's so many different ways to grow if you're savvy as an entrepreneur, but I actually have empathy for entrepreneurs when it comes to valuations. Because valuations, on the one hand, for me as an angel, it doesn't even matter as long as it's within a certain region. If I truly believe that what you're coming to build in the future is going to be valuable, then those pit points at the beginning aren't going to be a big difference if you're really going to build this 100x business. However, if you join an accelerator program, you can inherit a valuation because they invested at 100K at 5%, and therefore I'm 2 million pre-money. So valuations are actually quite tricky, and I understand why an entrepreneur would benchmark. Oh, because they raised that, I'm going to raise that. But you can also trip up on yourself. Some people raise on equity crowdfunding platforms from the public who are naive and don't know anything, and then they've raised such a high valuation, they have to raise something called a bridge round or a down round next, which sends a negative signal to the market that they're not succeeding in achieving their milestones and their growth. So valuations is a bit of a tricky territory for an entrepreneur, and I do have some empathy there. And after you have your 10 to 20 conversations, it starts to humble you, and you start to realize actually where that valuation probably should be. I always say that there's price setters and there's price takers. Price setters probably represent 1% of entrepreneurs. They're where they have oversubscribed rounds where everyone wants to invest into that business. But actually, a lot of entrepreneurs are price takers. I've been raising for 6 months. A little bit desperate, but I'm still trying to make the right decision in who I bring into my round.
Yeah. Actually, I was just going to say something to that. I think it's a great point on price setters and takers. One of the risks actually with, I need to raise the biggest valuation, is you end up with an investor that is not as aligned with you as an entrepreneur as they should be. And I think that's when you start to have issues at the end of the day. So again, coming back to what do you think the business can deliver and grow at? And if you have an investor that's coming at a super high valuation, they may not actually be value add. They may just be the guy that pay you the most. But actually, over time, they may not be value add, and that actually ends up being destructive for your business because of the things they're demanding that you do, which are not aligned to what you should be doing in the business. So I think there's also that tension to just be like, okay, they could give me the biggest price, but are we going to fight down the road? Or is there someone that can give me maybe a bit lower, but actually these are the guys that are going to be in the trenches with me, and even when things fall apart, they get it because maybe they're African or whatever. They get it and they can ride that with me. So that's another tension that we see.
Point. So good.
Absolutely. That support and sponsorship heavily underpriced, I say, sort of in this market. So we're almost at the top of the day. So I do want you to start thinking about the questions in the room. I want you to start thinking about questions you might want to ask. I see one hand up. Okay, let's gather some questions. What I do want to I want to flip the table a bit and talk and ask questions for those in the room who are not necessarily seeking investment but want to invest, right? I'm sure there are people who have some spare liquidity, a few couple of £100,000 just lying around, nothing to do with it. Like I'm just need a home for this amount of money. How should they think about investing? Whether from a retail perspective, or is there a way for them to also access institutional capital, whether directly or indirectly, maybe through fund of funds or anything like that? How should they be thinking about that, one? And then two, what are the things they should be looking out for as they're making decisions so they don't end up losing that nice pot of cash? people sitting around.
And did you want to go first? Because obviously this is where you...
Yeah, I think you have to know your why. It starts with your motivation. So if I'm investing because I want to learn about this new frontier and space technology, then that becomes your why. That's your driving factor as to why you're investing. That drives your thesis as to what you're going to invest in. But if you're not willing to answer those questions first, then I wouldn't even think about investing money. The second is you need to invest what you can afford to lose. You need to almost assume that all of this money is written off and I'm not going to get any of it back. If you can't afford to invest that, then reduce your number. Because you have to treat it like you're not going to make returns. We're not that great. We're not all that. All of us at selection. You know, the majority of our portfolios are failing. It's a small minority that drives the returns for the rest of the portfolio. So you have to understand that and have a portfolio approach to your investments rather than just a single investment approach. There's two ways of really doing that. One is you could be what we call like a limited partner investing into a fund, right? So an early VC fund, and you invest some of your capital into that fund, and that fund will then invest into a number of startups. Or you could join like an angel syndicate group to invest alongside other individuals who are a bit more experienced and can hold your hand and invest in businesses alongside you. Or you can take the risk and invest yourself, but you've got to get clued up and educated if you're confident enough to invest yourself as an angel. And you don't want to become that admin burden. I've seen that so many times on cap tables and with entrepreneurs where the investor shouldn't be the case, less than 1% of the company they own, from certain countries especially, but it becomes such a burden that they're distracting the founder from the product and the customers, which is their primary job. My job is to get out of the way and to enable you to do as much of that time that you need to spend with your customers, which is where your differentiation, your growth comes from, and from your employees who are creating all of the value. So I shouldn't really be taking up your time like that. So that example that was shared earlier, I want to double click on that because I see it all the time, even today, and it's not just an Africa problem, it's a global problem.
Yeah. Sorry, were you going to go double click? No, that's
No,
okay.
I want to emphasize
I was going to say, I mean, just starting point, obviously, before you do these sorts of investments, having a balanced portfolio, including public equities and bonds, do that before some of these investments that we're talking about here, which are more risky private investments. I think everything Andy said is spot on. I think maybe the one thing I'll add is especially this is the case very much in tech investments and venture. One of the best venture investors I know always says this, and I always remember this when I'm looking at venture investments, which is when you look at a venture investment, you always have to hold two things true in your mind at the same time. That number one, that investment could be 100x, but at the same time, that investment could be 0. Yeah. And you need to hold those two things true for every private venture type investment that you make all the time. And I think once you have that in your mind, it helps you think about, okay, how am I allocating capital? How am I diversifying across different things? I think the why point is really important because it's like, if you have 100K, do you put it all in one investment? Or do you say, do you know what, I put it through a fund, or actually I know quite a few people, one person doing agri, one person doing tech, one person doing this, I'll spread it out. So that's another way to think about things. I'll say maybe one last point just on the diversification point. So, there are not many private equity funds that give access to retail investors. I think in the UK and the US, there are some vehicles that allow people to get access to that. We're actually launching something like that in Nigeria that will give access to high net worth individuals who most people in this room will classify because of the way it's defined in Nigeria relative to here. And hopefully once that comes to market, that gives people access to some interesting opportunities.
Oh, that's brilliant.
There's one thing I'm working on as well, actually. It's quite early, so I wasn't going to mention it initially. But my whole background is like in angel investing and angel investing programs. And typically, venture capital firms like Sequoia used to have these scout programs where they would give money basically to certain individuals for them to go and invest. But the downside of those programs is there's no independence. So if I was an entrepreneur and I succeeded, but I was backed by another VC, I wouldn't be even allowed to join that program. So I'm actually in the conversation of launching like a scout program, if you like, that's independent, that provides capital to operators with experience to invest. And if those operators do well after a year or two, actually gives them more capital to invest in the hope that they're going to go and launch their own funds in the future. So if you like, it's an accelerator for micro GPs. It's a bit technical, I know. But if anyone's interested in that kind of stuff, come and have a conversation with me after.
Amazing. So it sounds like wanting to blow is not like a good enough reason to invest
raising money.
I want to blow. Just put my money in, money doubler, like just double my money.
Times two. That sounds like a Ponzi scheme.
Money doubling, you know. But I mean, it's true, really, because the average, unfortunately, the average African investor is still very much in subsistence type level, where as much as the money is discretionary, it's still not money people can afford to lose.
Yeah.
So they pay person. If you lose it, they gradually pay you. Like, it's not Elon Musk where you just be like, yeah, okay, up to the next one then, all right, you know. But it can be quite hurtful. Okay, so I do want to take some questions in the room. Okay, so I've got someone with a mic there, and I see Cecil's hand up. I saw you nodding all through, so yeah, this would be good. Let me take the person with the mic. Hello.
Francis Owusu, thank you so much for the panel. Super insightful. So I guess I had a question for sort of early stage founders. A lot of the mistakes are made very early on, you know, a messy cap table, you know, that sort of thing. I was just wondering, what are some of the checklists, positives and negatives that you know this company has when I go to IC? It's going to be a pass or it's going to be a fail?
Yeah. Okay, so for our venture fund, we are Series B+. So which means, you know, typically businesses that are generating sort of 4 to 5 million in ARR, which is obviously not annual, but ARR, and have some kind of product market fit. So at the first check, those are the things I would look for. We could go a bit smaller in terms of ARR, so it's really around the product market fit, because where we come in is to say, okay, the product is working, you already have customers that are paying more than 3 times already, you know. And where you are now is that you need capital to scale. So that's number one. I would say number 2 is the other things are just how we sort of see the founder. You know, Andy made a really good point around, you know, are you a founder that really believes in your business? And therefore, how are you thinking about who do I want to raise from? How much do I want to raise? And how connected are you to the product? For me, that's actually a really big one. Like, really, how connected are you to that product? Because when things are really difficult, and the connection might be your own personal experience, you're solving a problem for yourself. It just could be lots of different things. But having that connection, because when things get really difficult, I need to know that we can sit down together and you're not going to bail on me. I mean, if you have to bail, fine, but you're not going to bail on me. We can do it together. So those are some of the nuances. The cap table issue is, look, a lot of founders make that mistake because you raise from where you can when you're super early. So that, you know, we wouldn't fault you on that. If there's an opportunity for us to come in to clean that up a little bit, we would. We don't love doing that, but we would. But I would say, you know, raise where you can from when you're at that sort of early stage, because it may come from anywhere, quite frankly. But later on, I think having that mindset that, okay, look, the other thing we find is, you know, a founder may have, I don't know, like you said, 30 different investors that are problematic. One of the things they could do is put them all together in one vehicle and just let one person manage it. We can maybe come back later and clean that up, but I wouldn't worry too much about making sure you have a super clean cap table from day one, because you may not be able to, but having that conversation with your next round of investors, like, this is something I want to do now, is something that we would be able to.
Yeah, I think there's a big myth that founders believe around this messy cap table thing. Yeah. I promise you, if Uber, Airbnb, or any company that's got traction has a messy cap table, that does not put investors off, because they want to get in on the opportunity. So the cap table is not the be-all or end-all. A lot of my early stage investments, I ran it through special purpose vehicles where I would lead the vehicle and I'll bring in 30 smaller investors, sometimes £1,000, £5,000, but cumulatively it's over £100,000 that we're putting into a startup. So SPVs can be led by the founder or by an investor to just organize it in a neat way when you're investing around. In terms of like what we look for in terms of founders, you mentioned a little bit around like kind of founder traits and failure. You know, a second-time founder actually has some distinct advantages because they've got a network, they've learned from the experience of making mistakes, and they're going to start again more intelligently. So often, second-time founders are even seen more favorably after they've gone through a failure. The other thing that's really important, which is touched on earlier actually, is like solving real pain points. And if it's a personal pain point, you can tell stories like that, you're going to emotionally connect with someone. You know, they're going to understand what you're solving for. Even the articulation of your problem and being able to do that simply It's a task for founders that are too much in the weeds. When you're too much, you know your business too much, it's actually quite hard sometimes to surface it and communicate with clarity in a simple way. And then this understanding of the customer and how intimate is your understanding of the customer is important. Because you want a founder that really has a distinct perspective because they're so entwined with their customer that they leave you with curiosity so that after the meeting, you're Googling, searching, Clauding, and understanding that space more because you're just so intrigued by that encounter that you just had. Does that make sense? You're going to tell us things that we're not going to believe, like, I'm going to grow up and to the right. It never happens, that slide. Which is okay because we've made you tell us that. Because we've signaled that we care about traction, you're signaling back to us, yeah, I want to grow in this way. None of my founders, 17 in my portfolio, have grown in that way. But that's okay. As long as we can get to truth so that during the hard times you can turn to me and I can be in your corner, that's great. If we can't form that relationship where you feel like you need to always tell me positive stories and you can't tell me when you're going through hard times, then I've probably failed and you've probably failed in nurturing the right relationship because that's when I can be effective and that's when I would want to be used. You know, so there's a few things there in terms of founder traits and the relationship with the investor that's really important before the investment actually occurs.
And maybe just that last point is important. I would say I use the word lightly because I don't have the right word, but like a teachable founder.
Yeah, coachable.
Coachable, exactly. Which I use it lightly because as a founder, I do like founders who are like, go like, this is what I believe, I'm going for it. But at the same time, if it's a first-time founder, you've never built a business, you haven't built an organization, etc. So being able to take feedback, I think it's very important to nurture that relationship. And you sometimes you can pick that up even in the initial meetings you have with the founder, because when you ask certain questions, are they being defensive or are they also being like, okay, maybe I hadn't thought about that, but this is how I see it. Obviously you need to know your numbers and know the business, but you can maybe pick up on some traits around their coachability.
I think the biggest thing that I learned from spending time in Shenzhen in China and in San Francisco, Silicon Valley, is that a lot of us actually lack ambition. It's hard to hear that, but we think we're dreaming and we're not actually dreaming big enough. So to become a global category winner, you have to be so audacious.
Yeah, exactly.
People almost think you're on the verge of egotistical, but that is what is required to have global ambition. And some of us need to take tours of duty to go to these other ecosystems to really understand, are we stretching the thought of our ambition? Like, am I going to invest 100K as an angel, or am I going to raise 30 million to invest? We have to raise the level of our ambition, because if we shoot for the moon, if we miss, we're amongst the stars, but we've got to shoot for it. So some of us need to level up in that way as well.
I would caveat. in the tech space, I think that's true and important. I think there's some sectors where focus on like the thing that you're doing in the that you're doing. So there's also a little bit of still be audacious in that thing that you're doing. But if you say you want to change, poultry farming in Ghana, that's what you should focus on. Not that you want to change it. You might want to change all of Africa, but that's a different type of business because of the way it scales is very different to when you're scaling a tech business. So
I just want to encourage you that like Ghanaians can solve global problems.
Yes, exactly. I agree with that.
Brilliant. That's all.
Look, good conversation.
I thought you were coming to join us.
I know. Let's put a chair. Let's bring a chair here for you.
It's better when you stand and you speak. It's nicer. So, I've heard all this, but there's one word I was waiting to hear. It didn't come out, and it's not a fault. It doesn't come out. Project financing. So, what we're going through recently, most of the startups that are now being called scale-ups, we don't even know who we are anymore because we've been around for a decade, but we don't have the revenue to be called. So you can't even fund the opportunities you get with equity anymore because you also want to protect your equity. So you've built so hard, you've demonstrated product market fit, you've gone through all the right things. It took you 10 years, and now finally, the government believes in you and gives you 750 schools. It's going to cost you about 300,000 Ghana cedis to do one school. And that's 700, so that you need about 400, 500, almost 600 million Ghana cedis to do that. There's no way you're going to present your books to justify that. It just happened. So you make space for that because there's no name for us. We're no more startups, we're no more scale-ups. We just build quietly over time, and now we have credibility. We've demonstrated we can get this done. And now the big guy in the room is the government, the highest spender, trust you and say, hey, You've done 14 schools. I've seen what you got. Take 700 schools. Where do we fit in your equation?
Yeah, so I feel there's definitely a gap actually for businesses like that. So those don't even fit, they may not fit very nicely within VC. I agree with you. But what you do have now, which has taken a while to find that in the ecosystem, are these sort of debt-like structures.
Yes.
And I guess that's where you're going to. And what's different in what you said is like, this is not debt that is just like your standard bank loan. It's you're actually securing it based on the contract that you have, which gets you to get it at a cheaper price potentially because there's revenue visibility from those contracts. It's the in effect, if you're the lender, you're taking government risk. It's not even your risk because the government has to pay you. And so actually you're seeing a few of those types of credit funds. I would say that's what I would call them. They're a little bit of credit funds. Some of them are actually more impact funds who have a bit more flexibility on where they come in on the cap table. But yeah, I think from I don't know about the angel world, but from a VC perspective and a PE perspective, less so. Now, the way you find that actually maybe with the VC fund is where they do a hybrid. So they're saying, okay, fine, we're going to give you X amount as equity, and there's going to be this little amount of fund part of this project up to a certain point. Once you start to get revenue from that, you can pay that back and then fund the rest. So, but you're seeing a little bit of that. It's not common, you're right. But
you can use convertible notes in that way as well.
Yeah, exactly.
And you know what you realize when you speak to people who are active in the capital markets is deal structuring is a skill and it's a relationship-based skill. There's always a deal to be done with money if you know the right people with money. I know individuals that would do invoice factoring based on that contract that you just said.
Yeah.
There's certain institutions, financial institutions, that do asset-based financing and could figure out a way to use the schools as assets to say that's asset-based financing. Finance is so creative once you get into the right circles and meet the right people. So venture capital and we're just talking about a small fraction.
Yeah.
Like if I talk about the FX market in comparison to even the VC market, it dwarfs it by 300x. You know, so getting actually in with investment bankers and deal structures and capital markets, you'll be surprised the type of creative funding that you'll be able to unlock. You know, but I think that's the network to unlock that kind of pipeline that you have with those letters of intent and contracts that are coming in from government and schools.
Yeah.
Yeah, I mean, I'll add, I mean, from my experience sort of in the credit world, I mean, I think it's clear that if you lend to the United States, you're lending to an investment grade.
Exactly.
An investment grade country. You lend project finance in Nigeria, it's almost junk. It's B minus, right? So, even from an investment perspective, the risk is just as bad. You know, will the government actually pay back? How long will the government take to pay back? Is this country actually too big to fail? And I think that those are real questions, right? People are not willing to get into the muddy waters of, something that should be paid back in a year, all things being equal, now takes 36 months because they're trying to get through the bureaucracy of the economy. So, it's always an interesting one when you think about project finance, but in particular government backed. It's probably even worth having, being backed by a corporate than being backed by an African government, unfortunately. Well, a West African government, let me contextualize it. So at least those were some of the conversations I was having sort of in my seat as a credit investor. So,
but it sounds like, sorry, I was going to say, it sounds like it's the sort of thing, to Annie's point, that you can get local funding for that actually.
Yeah.
Whether local banks, local asset managers actually. Even some of the, what's also interesting, some of the B2C lenders, fintech lenders, they need to put their money into something, or they need to get capital in lots of different ways. So there are lots of structures that you can even do around that as well.
Okay, I am being told that we are out of time. This has been such a great conversation for us to think about. Some key takeaways for me was, build for the problems that you have, align your sources of capital to that. Don't be delulu, in some ways. Or be delulu. I mean, we kind of have different, it just depends, right? Be ambitious, but also be realistic about what is achievable within the timelines that you are working with. And as Andy said, reach for the stars or reach beyond the stars. Maybe how did you put it?
As a shoot for the moon.
Shoot for the moon and maybe
your version is good, don't worry.
I don't even know which one it is.
Thank you so much for your time. Thank you for the audience.
Thank you so much, Mary and her wonderful panel. A photo. A round of applause for them, ladies and gentlemen.